Welcome to the Hurst Trading Room Live. My name is David Hickson and it is the 21st of March 2016. We have daylight savings in the United States, no daylight savings yet in Europe. At least the changes haven't happened yet. So hopefully you've all managed to get here in one piece safely and at the correct time. Before we take a look at the markets, we need to, of course, take a look at these disclaimers. So let's go forward to those. These disclaimers are legally obliged. They are very important. So please make sure that you have read and understood them, because it is important that you understand what I am claiming and what I am not claiming. Right, let's take a look at the markets. And here is a chart of the S&P 500. No, it's not. That's a chart of gold. Okay, we're going to get back to gold. Here is a chart of the S&P 500, a very long-term chart. And the subject of today's webinar is troughs, peaks, and or both. And the reason for that is because the principle of synchronicity that Hurst defined states that troughs are synchronized where possible. And so you will be very familiar by now with looking at a chart like this. Let me change this time frame, make it a monthly chart because it's such a long time frame. And let me turn on those semicircles. There we go. So here is a chart that I expect you are very familiar with, and if turning on this pen, I've just noticed seems to simply get rid of my chart, so that's a little disappointing. Perhaps I'm not going to be able to draw on this chart. I do so enjoy. Oh, there we go. Okay, I've managed to get a pen working. Right. So you're very familiar, I'm sure, with this kind of analysis. For those of you who are new to Hurst cycles, let me point out that all the analysis information is presented at the foot of the chart. You can see here clearly these semicircles. Those semicircles are visual representations of the cycles that have been found in this price movement by means of a Hurst cycles phasing analysis. And in fact, right at the foot of the chart, although they're so small that you can probably hardly see them, but right at the foot of the chart are a whole lot of diamonds stacked up one above one another. And those diamonds mark the positions of the troughs. Now, there is a distinct sort of absence of analysis information at the top of the chart, as you can see. The top of the chart is completely blank, and that is because one of the principles of Hurst cycles, one of the principles that J.M. Hurst defined in the 1970s, is the principle of synchronicity, which states that financial markets are influenced by cycles, and that those cycles have synchronized troughs where possible. I've in fact done an entire webinar in which I spoke about the principle of synchronicity, so I'm not going to dwell on it. But the important point to realize is that when you are performing a normal Hurst cycles analysis, you are focusing on the troughs. In other words, you are looking at all of these troughs, and you are trying to work out what those troughs tell us in terms of what the cycles are doing. In particular, you are matching the troughs in price to troughs in the cycles. So you can see, according to this analysis, this trough here in 2009 is a trough of the 18-year cycle. Of course, that is because of this particular analysis. In our previous webinar 2 weeks ago, we discussed alternative analyses and positioning that trough in a different position and so on. But the important point that I would like to make today is that we are very used to analyzing markets by looking at where the troughs have occurred. Okay, that is simply how we do it. Let me zoom in a little and we can take a look at a little more detail on this chart so that I can take this argument just a little further. Here you can, I hope, see at this scale of zoom that at the foot of the chart we have these diamonds. Now these diamonds you're all very familiar with, I expect, these diamonds mark the position of very big prominent troughs. And the process of performing a phasing analysis actually has to do with identifying the really important prominent troughs and then working out what cycles those troughs represent. Okay, I expect most of you are familiar with that. So when you start working with Hurst cycles, certainly when I started working with Hurst cycles, the obvious question is, but what about those peaks? Okay, it's all very well identifying, that you've got these troughs, and here you can see a very nice, a beautiful example of an M shape, which is made in the markets because of the cycles that are influencing them, and we have identified the magnitude of the troughs of each one of those troughs, as you can see, and we've plotted those, and we've said this is a 9-year trough, this is an 18-year trough, and so on and so forth. If you're going intraday, you would go all the way down to this is a 30-minute trough or a 1-hour trough. But the important thing is you're identifying those troughs. What about the peaks? Well, it's a really fundamental question, and the principle of synchronicity is so deeply ingrained in Hurst cycles that everything about Hurst cycles, and particularly the way in which the cycles are presented, or the theory, the principles and the theory of Hurst cycles are presented in the Hurst cycles course, have to do with the fact that troughs are synchronized, and therefore you have a particular trading process that you would make as price bounces out of a trough. Okay, and you would have a very different trading process for when price forms a peak and drops down out of the peak. For that reason, when you're working with Hurst cycles, it is not true to say that a long trade, in other words, a trade that you would make as price bounces out of a particular trough, it is not true to say that a long trade is the same thing as a short trade, in other words, the trade that you would take as price falls down out of a peak. It's not true to say that they are the same thing, but they are simply inverted. They aren't. They are very different animals, very different types of trades, according to Hurst cycles, to the theory that Hurst put forward in his Hurst cycles course. And you will know, if you've done the Hurst cycles course, that the way in which you enter into a short trade is very different to the way in which you enter into a long trade. Apart from the fact that one is selling and one is buying, the thought processes, the logical processes behind identifying trading opportunities are very, very different. And the reason for that is because of the fact that in our analysis process, we have identified the positions of the troughs, but we have not identified the positions of the peaks. So when you're entering into a short trade, you don't say with great confidence, well, I'm dropping out of a trough of 40 weeks, perhaps, or 5 years, 4.5 years, or 9 years, or something. You don't normally give the magnitude of the peak. You simply say, well, here I have a peak of the cycle that I'm currently in. And that brings me to the important sort of way of looking at these peaks. So let me just clear that, and let me show you how when you first approach Hurst cycles, or I should say when I first approached Hurst cycles, this is how I looked at these peaks. Here I have a trough of 18-year magnitude. Okay, yes, let's call this an 18-year magnitude trough. It's actually slightly off my chart, but it's good enough for now. And here's another 18-year trough, 18-year cycle trough. So I'm going to label those 18-year and 18-year. Here is a 9-year cycle trough. Okay, so the way in which I initially approached the whole concept of peaks is this. Here we have price bouncing out of an 18-year cycle trough, and of course a 9-year cycle trough, and price goes up, forms a peak, and then comes down into a 9-year cycle trough. then it bounces up again, forms a peak, comes down into the next 18-year cycle trough. So therefore the magnitude of this peak is clearly 9 years, okay, because you are simply saying the highest price between two troughs of the 9-year cycle is clearly the 9-year cycle peak. That's the logical way of looking at it. And here is another peak, which is also a 9-year cycle peak. Why? Because it is simply the highest price between this 9-year trough over here in 2002 and this 9-year trough here in 2009. So those are both 9-year cycle peaks. Excuse me. So those are two 9-year cycle peaks. Fantastic. But if I draw another cycle that is active here, that is the 18-year cycle. So now where is the 18-year cycle peak? Well, the obvious answer to that question is that the 18-year cycle peak is very simply the highest price within that 18-year period. Okay, and I think the highest price was over here. So in fact, this peak here is the 18-year cycle peak. Okay, this is what I call the simple approach to identifying the peaks, because all you do is you look at where the troughs are and you find the highest price in between two matching troughs and you say there is the peak. Okay, Hurst's principle of synchronicity tells us that troughs are synchronized where possible. However, peaks aren't necessarily synchronized. What does that mean? Well, it means that the peaks of the different cycles are not necessarily going to occur at the same time. However, if you think that through logically, as I did, I have a tendency to question any theory I come across or any ideas. I question them and I quite enjoy interrogating them. And so I thought through this logical process. And let's just zoom in here on this 9-year or 18-year cycle peak. And let's just zoom in and look at it in a little more detail. We have already agreed that because this is the highest price in the current 18-year cycle, that must therefore be an 18-year cycle peak. Okay, so it definitely has 18-year magnitude. We also know that it's the highest price in the current 9-year cycle, so it is therefore also a 9-year cycle peak. Okay, and if we look at the 54-month cycle, and there's a 54-month cycle trough, then this same peak over here is also the peak of a 54-month cycle. I think you know where I'm going with this. I don't really have to go all the way down to the 5-day cycle. But the fact is that that peak that we've identified as the 18-year cycle peak is in fact a synchronized peak. Hurst's principle of synchronicity states that troughs are synchronized where possible, but that does not mean that peaks are not synchronized. So that's the first fairly important concept. Hurst did present a chart, and I wanted to try to scan it and show it to you today, but unfortunately it's one of his really big formats, so I wasn't able to do that. But he did publish a chart in which he presented the markers for the different peaks with triangles. Okay, and he showed through demonstration of that chart how the peaks tend not to be synchronized, but the troughs are synchronized. Nevertheless, if you look at any one of those peaks, then generally, in fact, you do have a synchronized peak. The important thing is that you cannot expect the peaks to be synchronized. So there's a rather sort of a subtle thing that goes on here. So let's explore this a little further, and let's speak about identifying peaks and how we can identify peaks. As I've mentioned, there are various approaches, and the first approach is the obvious, really simple approach. So what I'd like to do now is quickly change to a different chart. This is also a chart of the S&P 500, but let's start speaking about what's happening right now in the markets to try to bring this conversation sort of a little more current so that it can start meaning something. Here is an analysis that we've discussed a lot recently. I'm not going to dwell on it here. If you have any questions about it, then please go ahead and ask. You can see this analysis believes that the 18-month cycle trough is the trough that occurred on the 11th of February, and so that's a really important trough. Now, if we look at the most recent 18-month cycle, which has played out since, according to this analysis, February of 2014 up until February of 2016, a fairly long 18-month cycle, and we could debate that, but let's not get bogged down by too many details at the moment. Where is the 18-month cycle peak? Well, again, using the simple approach, the peak is very simply the highest price. So here is the 18-month cycle peak, and that is in, was it in June, I think, or perhaps, no, late May of 2015. So that's the 18-month cycle peak. Now, you might know, I believe that is possibly a 9-year cycle peak, so it could be a really, really big, powerful peak. But as we zoom in onto the shorter and shorter cycles, and I don't want to waste too much time doing this because it's a fairly obvious point, but as we zoom in here, we can see the 40-week cycle, and where's the 40-week cycle peak? There it is over there. It is, in fact, the same peak. Okay, so although the principle of synchronicity does not state that peaks are synchronized, nevertheless, they very often are. And let's zoom in to the next cycle, which would be the 20-week cycle in that time period. And again, the highest price in that 20-week cycle is the same price over here late in May of 2015, so that is also clearly a peak of the 20-week cycle, and we can continue that process all the way down, 80-day, 40-day, 20-day, and so on. Okay, that is the simple approach, and it is I see a question from that's quite a complicated name. Is it SPX? Yes, this is the SPX. It's in fact the ES futures, but it's effectively the S&P 500 futures. So it's similar to the SPX. I hope that answers that question. So that's the simple approach to defining the peaks and to understanding the peaks. However, the problem with that approach is, for a long time, it felt to me that we were only looking at half of the picture. We were only looking at those troughs. For instance, let's speak about what's happening right now. Okay, and let me keep the zoom scale the same. According to this analysis, price is bouncing out of an 18-month cycle trough. And it's gone up really well. It's gone up really fast. Okay, fantastic. It looks really good for an 18-month cycle trough. Where's it going? When is the peak going to be? Okay, are we expecting a peak now? Are we expecting a peak in 9 months' time? Is that going to be when the 18-month peak is going to happen? What about the 40-week peak? When's that going to happen? Is that going to happen in 20 weeks? We don't know. You know that, of course, because of the way in which cycles combine, it is possible to estimate, because of underlying trend, it is possible to estimate whether peaks will occur early or late. So let me show you a quick example here. This 80-day cycle from here, from October of 2015 until February of 2016, this is an 80-day cycle. Okay, but it has a negative underlying trend, a bearish underlying trend. Why? Because the 20-week cycle is coming down into a trough. So therefore, the 20-week cycle is clearly moving downwards. The 40-week cycle is doing the same thing, moving downwards. The 18-month cycle is also moving downwards. So the cycle, the 3 cycles longer than the 80-day cycle, are all pushing downwards, which means that we have a bearish underlying trend. We've got bearish pressure from the longer cycles. When you have bearish underlying trend, you expect the peak of a cycle to occur early. So here is therefore that 80-day cycle. If I just draw it as a curve, you would expect the midpoint of that cycle to be about here. Because of the bearish underlying trend, you would expect an early peak, and indeed we did get an early peak. So you know that you can use the concept of underlying trend and the pressure of the longer cycles to work out whether a peak should be expected to occur early or late. But you know, as a trader, I find that very vague. I find it a horribly vague concept to think that I'm expecting a peak to occur early. Okay, how early? Okay, there are various logical processes you can go through, and you can look at all the shorter cycles, and as you look at all the shorter cycles, you can work out where the underlying trend turns from bullish to bearish, and therefore work out roughly where you expect that peak to occur. But it is nevertheless a fairly vague process. And so I asked myself, what would happen if I actually performed an analysis on this data, an analysis of the peaks, not just an analysis of the troughs? Okay, but there's an important thing to be noted here. Up until now, I've been using what I call the simple process for identifying the peaks, which is simply identifying, what is the highest price in each one of these particular cycles that we're looking at. That's a very simple process. It's very easy to do. You don't need to perform an analysis. But I asked myself, what would happen if I did perform a full analysis on the peaks? Wouldn't that be really quite interesting? So I did some work on Sentient Trader, and let's just go back to our very long-term picture of the S&P 500, and let's go all the way out again, and let's change that to a monthly chart, and let's display our peak analysis. Now, at the foot of the chart, let me turn on our semicircles, because semicircles make an analysis quite nice and easy to see. There we go. Now you can see a slightly more detailed chart. Here at the foot of the chart, we have the same trough information, but here at the top of the chart, we have some peak information. Now, it's very important to realize several things about the information presented at the top of this chart. First of all, an entirely separate analysis process has been performed on the peaks. There's an inherent problem there that I'm going to come back to. I'm sure some of you are already thinking about it and identifying it. I'm going to come back to the inherent problem, but let's just put it out there that an entirely separate analysis has been applied at the top of the chart, has been applied to the peaks. Okay, it's a separate analysis to the analysis that has been performed on the troughs. So it is not the simple process of saying what is the highest price between two troughs. And let me see if I can demonstrate that to you. In fact, you'll find that often there isn't a huge amount of difference between the two analysis processes. But let me see if I can find. Here we go. I think this might provide us with a good situation. Okay, and right. Let me just leave those. And let me zoom out again. It's quite difficult. Let me just stay on the wide scale. I think that might be easiest. Using the simple approach, in the course of this cycle over here, and this is an 18-year cycle, in the course of that cycle, we would identify the peak of that cycle as being the highest price. Okay, and the highest price is a little difficult to see. It might be over here or it might be over here. I think it is probably over here. So using the simple process, we would say therefore this over here, I hope you can see those arrows I'm drawing. That over there is the peak of the 18-year cycle. Now, using a separate analysis process, which I call a dual analysis, that peak might also be identified as a peak of the 18-year cycle, or it might not. And I think what we should do is zoom in, and I'm going to show you some detail, because when we look at the detail, you're going to see some really interesting, logical, slightly confusing things occurring, because we have a dual analysis. We have two analyses on this chart. We have a trough analysis and we have a peak analysis. These peaks are not identified simply as the peaks of the troughs that have been identified. Perhaps I should try and say that again, didn't come out very clearly. The peaks that are identified using a dual analysis are not simply the peaks of the cycles that have been identified because of the trough analysis. I hope that's clear. It's a really important point. I've performed a trough analysis here at the foot of the chart. The peak analysis is not simply the matter of finding the highest price within each one of these cycles. I've in fact performed a separate analysis. Okay, I've said that so many times you're probably beginning to fall asleep. So let's switch to a shorter time frame chart and have a look at some of the consequences of this dual analysis. I see a question from Brian. Did you ever perform an analysis on the reciprocal of, say, the S&P, which would yield the troughs that would correspond to the peaks? Brian, yes, indeed. That's how I started doing this. Is I started performing an analysis of the reciprocal. And in fact, let me just pause here quickly and give a little bit of background into why I started doing this. We're looking here at the S&P 500, and there's a good reason I've chosen the S&P 500. It is a stock, and stocks, or it's a stock market, I should say, it's an index. Stock markets work very well with synchronized troughs for their analyses. Commodities and precious metals, such as gold, work very well, in my opinion, with synchronized peaks. So the first thing that I started doing when I started exploring these concepts is before Sentient Trader could perform what's called an inverted analysis, a peak analysis, before it could do that, I would get prices of gold, and I would use Excel and I would invert the prices, because of course gold is quoted in dollars, so you can easily get the reciprocal, and so you get the inverse. And I performed analyses like that, and then I would print out my charts and turn them upside down, and I had an analysis. Well, you need to look at them in a mirror, or something like that. But it's not quite as simple as turning them upside down. But yes, I started with upside down analyses. So I performed a trough analysis on that. Then Sentient Trader developed the functionality to be able to perform peak analysis. And so then I started analyzing gold using peak analysis. Then I started asking myself, what would happen if we did both? And in fact, Sentient Trader has been able to do both for several years now. But you might know, if you are beta testing the new version of Sentient Trader, this is a feature that is being released publicly in the new version of Sentient Trader. Here we go. I've turned on the peak analysis, and some things are probably going to jump out at you straight away. Let's focus on these peaks for a moment and ask ourselves what the peak analysis is telling us. Well, first of all, when we had only a trough analysis, as I mentioned, prices bouncing out of an 18-month cycle trough, and I was left asking myself, where is this peak going to form? I've got no idea. Price is bouncing out of a trough, which I can identify quite clearly now because I have the benefit of hindsight, but I can identify that trough as an 18-month cycle trough. But where on earth is it going, and when's it going to form a peak? Well, the peak analysis is giving us a very good, clear answer. The peak analysis is telling us, can you see this nest of highs? Is telling us that price is bouncing into a 40-week cycle peak. Okay, so earlier on I asked, when is the 18-month cycle peak going to occur? Well, I didn't know. When's the 40-week cycle peak going to occur? And when you first start working with Hurst cycles, you imagine that the 40-week cycle peak is probably going to occur somewhere around about halfway through the 40-week cycle. So let me just clear those marks, and let's just scroll this chart over to the left. And let me draw some more things over here. Starting with only the peak analysis, we know that following an 18-month cycle, trough price is going to bounce out, and it's going to form a peak and then come down in 18 months' time into an 18-month cycle trough. The 40-week cycle is going to cause price to bounce up, come down, form a peak, and then come down to the 40-week cycle trough. Can you see that there? The 20-week cycle is going to do the same thing. Okay, and you're going to expect each of these peaks somewhere around about halfway through the cycle, depending, of course, on the underlying trend. But now we have a peak analysis, and that peak analysis is telling us when to expect the peaks of each one of these cycles. Can you see the peak of the 18-month cycle? Here it is over here. That's the nest of highs for the 18-month cycle. Now, I very roughly drew an 18-month cycle over here, this top white line, but halfway through the 18-month cycle would be about here. Can you see how the peak analysis is telling us to expect the 18-month cycle peak to occur early? And here's the peak of the 40-week cycle. So the peak of the 40-week cycle is expected very soon. It's, this nest of highs is right upon us. We're expecting the peak of the 40-week cycle to occur very soon. So that means if that's a peak of the 40-week cycle, then that means that that's going to be a very, very early peak for the 40-week cycle. Okay? Now, having said that, let me get back to the problem, the inherent problem that I mentioned earlier, and I promised I would come back to. The inherent problem with this is that the analysis process that we're applying to the peaks assumes that they are synchronized. I spent 10 minutes earlier demonstrating how peaks, even though they are not required to be synchronized, how peaks very often are synchronized. And most of the peaks that we find are indeed synchronized peaks. But when you're applying an analysis process that requires synchronized peaks to the data, there is an inherent problem, which is that it might not be valid. So you need to bear that in mind. Okay, we're applying a process that assumes synchronized peaks to a price movement that might not have synchronized peaks. Now, that is slightly problematic. So why do I do this? Why do I apply this dual analysis of peaks and troughs? I apply it because even though there is an inherent problem, nevertheless, it gives us very, very useful information. And when you start working with this, which if you're a sentient trader user, you will start doing very soon, when you start working with this, I think you're going to find it provides you with huge insight into what the markets are doing and what you can expect them to do. But it is important to bear in mind that there is that inherent problem. Now, I see some questions there, and I'm going to get to them in just a moment, but let me just zoom out here a little bit. There is something else to be aware of when you're performing a dual analysis, and that is that one of the analyses is probably going to be very good, while the other analysis is probably not going to be very good. It seems like a funny thing to say, but if we assume that markets have synchronized troughs or they have synchronized peaks, it is impossible for them to have both. It's logically impossible. But if we assume that they primarily have synchronized troughs and not synchronized peaks, then what you should find is that your trough analysis is more accurate. It is better than your peak analysis. And indeed, that is what usually happens. In fact, what I find happens, and let's quickly take a look at some other charts here. Here's a chart of the euro to US dollar, and so if I show the peak analysis on the euro to US dollar, I could spend quite a lot of time sort of talking about this analysis, but I think you can see quite easily, simply from the evenness of these semicircles. Can you see how even the semicircles are here at the top? Particularly in this period here. This is the euro to US dollar, I think I said that. In this period over here, we're getting very good, accurate peak analysis. Okay, now forex pairs can very easily be analyzed any way up, because there isn't a right way up. For me, as somebody living in Europe, the euro US dollar looks right this way up. When the chart goes up, my money is worth more. Okay, if you're in the United States, you would probably rather analyze this chart the other way around, so that when the line goes up, when the price goes up, your money is worth more. So there isn't a right way up in terms of forex pairs. So forex pairs are very interesting to analyze using dual analysis. And what you will find, in my experience, is that there are periods of time when the peak analysis will be spot on. And in my opinion, that's exactly what happened over here in the euro to US dollar. The peak analysis is just perfect. It works brilliantly. And then there are periods of time when the peak analysis starts to fall apart, which is what happened to the euro US dollar after the 2008 peak. After the 2008 peak, the peak analysis started falling apart. But I don't know if you can sort of see it at this scale, but the trough analysis started making more sense. And that is what I believe happens in forex pairs, is that you get peak analysis working really well for a while, and then trough analysis working really well, and then peak analysis again. However, when one of them is working really well, even though the other is not working quite so well, that doesn't mean that it is useless information. It doesn't mean that it is information that has no significance for us. If I zoom in on this chart of the euro to US dollar, you can see here how the peak analysis has been providing us with very useful information. In particular, it's showing us a nest of highs for the 20-week cycle trough over here, showing us that this peak over here in February almost certainly was a peak of the 20-week cycle. But let me just point out something here. Do you notice this 18-month cycle peak on this price peak here in early October? What about this price peak over here? What was that? Can you see how it hasn't actually been labeled pretty much as anything? It's been ignored by the analysis. Now that is an indication of an analysis that is not perfect. There are some problems with this analysis, and we could tweak it, we can pin it, we can move these peaks around, but it is something that you will often see when the trough analysis is working well, the peak analysis will work less well. Okay, it's quite an important point. I've missed lots of questions or comments, so let me go back and see if I can answer some of those. Jay says, how does this change the composite line shown 2 weeks ago? In fact, Jay, it doesn't. The composite line is based upon both analyses. Okay, so it doesn't change that composite line at all. That composite line that I showed you 2 weeks ago was based upon both trough and peak analysis. We're not really going to have time to speak about the composite line in today's webinar, but let me just go back and show you show you what this composite line is doing. I don't think I've built it. Yes, I have. And okay, now I'm obviously displaying it on something else. And okay, I haven't actually refreshed, or perhaps I need to rebuild this composite line, and then we can have a look at it properly. Or perhaps I was showing it to you on a different chart. So this composite line is really quite bizarre. It's probably not worth wasting our time trying to speak about it. I wonder if I've got a composite line on this chart. I might have a slightly better slightly better analysis here. And let me turn off the semicircles, go to daily, and let's build this model. There are a few sort of hoops you have to jump through to get a composite line working for you. And after that's built the model, it can take a while to build the model. While it's doing that, let me see what other questions we have here. Stuart says, David, you're asking the question of where the peak forms based on a trough, but by using an unrelated peak analysis, you're not answering the question of where a peak forms given a trough analysis. Yes, Stuart, but I'm going to bring this conversation full circle and show you why that's nevertheless a very useful thing to do, in my opinion. You know, I'm asking as price bounces out of a. Let me just show this quickly while we're looking at it, and zoom in here. Okay, that's the composite model line here for this analysis. It's got a very high amplitude cycle in there, which we would need to remove. Once we've removed that high amplitude cycle, it might make a little more sense. Okay, so the composite model line is not really helping. Let me get back to Stuart's question. That I'm asking a question about where the peak is going to form, but I'm not directly answering that question. That's true. I'm not, in fact, as price bounces out of this 18-month cycle trough over here, I ask myself, where's the peak going to form? I'm not directly answering that question, but in fact I'm answering a more important question in my opinion, and I hope to show you that. We've got 20 minutes left on today's webinar. I hope to bring it full circle and show you what a peak analysis can provide you with the information for. You know, what it boils down to, and let me just zoom out a little bit on this chart. What it boils down to is that there are various ways of looking at cycles and how they move the markets. Let me just zoom in here. Okay, let me turn off this this peak analysis. There are various ways of looking at cycles, and the one way of looking at cycles is saying that let's look at this 40-week cycle, for instance, saying here is the 40-week cycle. It rises up, it forms a peak, it comes down and forms a trough. Then it comes up again, forms a peak, and then forms a trough. Okay, and so as price bounces out of this trough over here back in February of 2014, you might ask yourself, where is the peak of the current 40-week cycle going to be if you're trading the 40-week cycle? And so, you know, if you had excellent analysis skills and you know, 100% perfect future vision, you might say, well, that 40-week cycle peak is going to occur in September, so you should hold on right up until we get to September. I take a slightly different approach. As price bounces out of an 18-month cycle trough or a 40-week cycle trough or whatever trough it is, I don't ask myself, when is the peak of this particular cycle going to form? I instead ask myself, what is the next peak of some magnitude that is going to form in the markets? And I suppose that's why Sentient Trader now has the ability to perform this dual analysis, because it takes that slightly different approach. I hope that makes sense. So as price bounced out of the trough in February of 2014, instead of asking myself, where is the peak of the 18-month cycle going to be, or where is the peak of the 40-week cycle going to be, I instead asked myself, where's the next you know, peak that I need to pay attention to going to be? And depending on your time scale that you trade, you know, you might work with very different time scales. But you know, if you're a bit of a swing trader, then probably a 20-day or a 40-day peak would be quite important to you. If you're an investor that's in it for the longer term, then you know, those 20-day and 40-day peaks aren't of importance to you. But you will still be asking yourself, when is a peak of some magnitude going to occur? And if I display the peak analysis, you can see that if I'd been monitoring this peak analysis, and of course, by no means would this peak analysis have been exactly the same 2 years ago, okay? It might well have been quite different. But as price bounced out of this 18-month cycle trough, assuming the analysis had been the same, then the peak analysis would have been warning me that, in fact, I've got an 18-month cycle magnitude peak coming up. So that's a fairly important peak. So I would probably want to trade into that peak and then start thinking about getting out. Okay, I hope this is making sense. It's a matter of what questions are you asking yourself. And as price bounced out of the trough in February, and I started saying to myself that might be a trough of the 18-month cycle, I didn't ask myself when is the peak going to be. Instead, I asked myself when is the next really important, quite big magnitude peak going to be? And the answer is here in my peak analysis. Here is where the next peak is expected, a nest of highs. So it shows us that the peak that we're approaching is likely to be quite a big magnitude peak. So I'm asking a different question. I hope that makes sense. Somebody's name, unfortunately, I can't read. Shop trading, a double bottom with an 8 stack is a loading zone. There we go. Okay, so if you're familiar with a shop trading approach, then of course when you get a double bottom forming, and that was probably written a while ago, so I've since changed charts and we're looking at a totally different scenario. But when you get a double bottom with an 8 stack, an 8 stack is a pile of 8 diamonds. Very powerful, obviously. It's a loading zone. In other words, you start buying, you start loading up. William, the quote price relationship of FX pairs makes peak analysis more feasible. Absolutely. I know I've taken too long to get back to these questions, so that was a useful comment made earlier. Stuart, would it not be more useful to display where the peak is expected to form given trough analysis, even if not synchronized? Stuart, it might be, depending, of course, on your trading approach. Of course, I'm going to be honest. Sentient Trader is a selfish piece of software. I built Sentient Trader for myself, and I built it as a tool so that I could, really enhance my trading. So it takes an approach that suits me. Yes, you might find it much more useful to display where the peak is expected to form given the trough analysis. However, actually that process is really quite a lot easier. Okay, because what you do is of course you work out what the underlying trend is going to be, and you start drawing your M shapes, and you start asking yourself, is the peak going to be in the first or second part of the M shape? If it's the second part, then you zoom in on this cycle over here, and you ask yourself that same question. So then you get another M. Is it going to be the first or the second? And if it's the first, then you've refined the position of your peak. Okay, so that's how you could do it just using the trough analysis. Richard Harris, have you ever used geometric cycles based on 360 degrees circle equaling 1 year with 30 degrees equaling 1 month? No, I'm familiar with the concept, Richard. I've never done it. Quite an interesting thing about working on Sentient Trader is that developing Sentient Trader has taken up so much of my energy and time that I haven't explored many sort of variations on the concept of cycles for quite some time. It does sound like a very interesting approach, and I have read a little bit about it. And it is a fascinating approach, linking time to the geometry, if you like. Okay. Now, let me sort of get to the point. I've shown you a trough analysis. I've shown you what Sentient Trader can do in terms of forming a peak analysis. Let me show you where this train of thought ended up taking me. And let me zoom out again on this chart. What are we looking at here? The S&P 500. Yeah. So let me zoom out here, and let's display this weekly, I think. Okay. All right. Now let me show you something that tends to happen when you have a dual analysis. Not when you have a trough analysis with calculated peaks, but when you have a dual analysis with troughs and with and with peaks, two separate analyses. Let me show you what tends to happen. What tends to happen is the price moves from a trough. So let's look at the 18-month cycle, which is this yellow cycle. Price tends to move from a yellow cycle trough, of course, to a yellow cycle peak, then down to the next yellow cycle trough, then up to the next yellow cycle peak, then down to the yellow trough, and then up to the peak. Okay, and then something interesting happens, because the next peak, the next trough, I beg your pardon, of a yellow cycle is right over here. So in fact, the move that should have been a downwards move into the next 18-month cycle trough ended up being an upwards move. Then we had a move up into that peak over there, and then do you notice that we don't have another yellow 18-month cycle trough before the next 18-month cycle peak forms in the market? Okay, so in fact we've got a line moving up to that 18-month cycle peak, and we've also got a line moving up to that 18-month cycle peak, and we don't really have a prominent 18-month cycle trough in between them. And then we get a move down into the next 18-month cycle trough. So I noticed that if you draw lines, which I call zigzags, because of course they're very similar to the standard zigzag indicator that is used in technical analysis. If you draw lines between the troughs and peaks of particular cycles, then you get a bit of a zigzag pattern happening. I haven't even begun to show you that zigzag pattern, so before I answer any questions about it, let me show you in a little more detail. And in fact, let me show you on the Euro-US dollar, because that is a workspace. That's a chart that's been working extremely well recently. Here we go, between the two analyses. So let me draw a line now connecting the 18-month cycle trough and the 18-month cycle peak. Here it is over here. There's the trough, the 18-month cycle trough, and there's the 18-month cycle peak. All right. What's the first thing the price does when it bounces out of an 18-month cycle trough? It, of course, heads up quite strong and quickly. Where does it go to? It goes to the highest magnitude peak, okay, that is going to occur before the next 18-month cycle peak. So the highest magnitude peak that's going to occur is the 20-week peak. So it goes up to there, at which point it turns down, and it comes down to the highest magnitude trough that is going to occur before the next 18-month cycle trough. So what's the highest magnitude trough? It's the 40-week cycle trough over here. So it's going to come down to that 40-week cycle trough like that over there. I don't know whether many of you are familiar with harmonic trading, but you're going to start seeing the harmonic trading patterns as I draw these zigzags. This process can be continued at greater and greater detail. So as price bounced out of the 40, it's done that to me again, it's given me a black screen, there we go. As price bounces out of the 40-week cycle trough, it's going to go to the 20-week cycle peak, which is over there. But in order to get there, it's going to follow a zigzag. It's going to go up, then it's going to come down again. It's going to cross the center line, and it's going to come up to the peak, which is probably over there. Okay, so you start getting what many people would call market geometry. They are harmonic trading patterns. All these things work together, and this is simply a Hurst approach, if you like, to the way in which all of those things happen. The advantage of performing a dual analysis is I can now get Sentient Trader to draw those lines for me. I've been drawing them very badly here, but I can get Sentient Trader to draw those lines for me, and those lines are called zigzags. So let me show you some zigzags, And there we go. Here is the zigzag for the 20-week cycle. I call it a zigzag. I know there is a separate indicator which is a zigzag. I'm sorry about the confusion. It's just a little name I gave it. So here is the bounce out of the 20-week cycle trough. And here's the dashed line that represents the move up to the next 20-week cycle peak. What will usually happen is you get a harmonic trading pattern, which goes up like that, and which forms a zigzag. Okay, can you see the zigzag there? There are two triangles. All right. It's not groundbreaking new material, but it's a very useful way of looking at and understanding the geometry of how these cycles are working together. Now, I started off this webinar sticking strictly to Hurst cyclic principles, and some of you might be purists, you might be Hurst cycle purists, and you might be saying actually you're going beyond the pale here because you're leaving Hurst cycles behind and you're developing all kinds of new ideas. Yes, indeed, by combining a trough analysis and a peak analysis, I'm experimenting with new ideas in Hurst, but they are new ideas that I have found to really work very well in terms of knowing what to expect in the markets. So to get back to Stuart's question in a way, when the euro to US dollar bounced out of this 40-week cycle trough way back in November of last year, as a trader, of course, I'm asking myself, where am I going? Okay, I've bought into this market. I've bought into the climb out of this 40-week cycle trough. Where am I going? The advantage of these zigzags, or the zigzag approach, and the dual analysis is I can, at a great deal of detail, I can say, well, the 20-week zigzag is going to bring me up to a peak sometime here in late February probably. Okay, but in order to get there, it's going to bounce up to an 80-day cycle peak, and then bounce down to an 80-day cycle trough, and then bounce back up to the 20-week cycle peak. How much of that move do I want to sit there for? Okay, I can tell you I'm not very patient. Recently I've become less patient with trading. I've started looking at shorter charts, you'll be surprised to know. And knowing that an 80-day cycle peak is going to form within the space of a few weeks gives me quite a strong reason to look at simply trading the first part of this move, and then waiting as price comes back down again, then considering getting back in for the second part of that move. And now we can do this at all kinds of degrees of scale. So I can show the zigzags for the 80-day, and here you can see the 80-day zigzags, and we can look at it for the 40-day and so on. We can do it for all of these different cycles. So when price bounces out of a particular trough, you are going to be asking yourself, where is the peak that I'm trading towards? Or as price drops down out of a peak, you can ask yourself, okay, where am I going with this? Where's the trough? Where's this trough going to occur? Now, there's one final thing I'd like to show you about these zigzags, and that is that you can generate statistics on the basis of them. I don't know whether you can see that. The text is really very small on my screen, and at my age I can't read all this stuff so clearly anymore, but hopefully you can see some of that over there. Perhaps if you're watching this at home, you can zoom in on the video. But what Sentient Trader does is it calculates these zigzag movements for the entire price series that you have, and it works out where the line is crossed in terms of percentage. So now this is the 20-week line. Okay, from here to there, that's the 20-week line. It was crossed by this dotted line over here. Okay, that looks like about 35% perhaps. So it works out the range of time that the crosses can occur. It also works out what percentage of the cross line is important. I won't dwell on that, it's not important for now. But it also gives you a valid percentage. So I don't know if you can see that, but for the 40-week cycle, 86%, I think it is, of these zigzags have been valid. By valid, it means that the line ends up higher than it started. If you're moving from a trough to a peak, then a valid line is one that moves upwards. If you're starting from a peak going down to a trough, then a valid line is one that goes downwards. The validity of the 20-week cycle is 88%. What kind of zigzag am I expecting for the S&P 500? Let's take a look and probably start wrapping this up here. I wanted to show you a little bit of, no, I don't think there'll be time. All right, so what zigzag am I expecting here? So let's zoom in and focus on a little more detail. Okay, so, all right, well, let's just go back again. This is the 20-week zigzag. So this is the zigzag that Sentient Trader has generated for the 20-week cycle. Notice that the interesting thing is that Sentient Trader has already called this the 20-week cycle trough, peak, I beg your pardon. It's already said, okay, the peak has happened. Don't take that too seriously. That is not Sentient Trader saying the peak is in. But it is Sentient Trader saying that to all intents and purposes, this upwards part of the zigzag is now complete, and therefore we need to stand by for the move down for this part of the zigzag. It's just another way of taking your Hurst cycles analysis information and generating ways of knowing what to expect next in the market, because of course that's what this is all about, is using the analysis information to work out what we can expect next. Let's have a look at the 80-day cycle zigzag. So there's the 80-day, and there's the 40-day. Okay, so the 40-day cycle zigzag is also stating that we're expecting price to come down fairly sharply. Then, of course, it will bounce across the 80-day line, come down to the 80-day zigzag, form a trough here sometime in May, and that will be then the prior move, and then we're going to get another move up for the zigzag for the 20-week cycle, and we're going to get that. So those zigzags are telling us to expect that kind of a price movement over the next several months. Okay, Paul says the zigzags look very much like Andrew's median lines, which would bisect the cross line. They are very much, Paul. In fact, when you look at your, when I look at my zigzag lines and I plot Andrew's pitchfork, I think it's called Andrew's median line. Is it Andrew's pitchfork? Anyway, there's a fairly well-known indicator that does a similar thing. And in fact, as you say, they are really very, very similar. They're effectively doing the same thing. They're just taking a slightly different approach. The Hurst zigzags are working with the Hurst cycles analysis information, and in fact, if you plot an Andrews pitchfork indicator on a chart here, you will see exactly this 20-week zigzag. Let me show the 20-week again. There we go. You will see exactly this 20-week zigzag with price, price coming up to the 80-day, coming down to the 80-day, and then bouncing up to the 20-week. And in fact, that proved to be a perfect projection for an Andrews median line. It was within ticks, I think, of it achieved that target within ticks. Well, that brings to an end everything I wanted to speak to you about in terms of performing not only a trough analysis but also a peak analysis, and then combining them so that you get dual trough and peak analyses. And it's, in my opinion, a very useful thing to do. It is an extension of Hurst cycles principles. So if you are a Hurst cycles purist, you might be shaking your head and saying, "This is all, this is all a lot of nonsense because it's not pure Hurst." It isn't pure Hurst. You're right. It is an extension of Hurst cycles, and it's an extension of his work that I find really very, very useful. Bob has asked, "Can I show gold analysis?" Yes, indeed. And let me have a look at this. Let me zoom in here. This is gold, and I have a peak analysis here. I have a peak analysis on all my charts. Whether I use it or not is up to me. I like doing a peak analysis. You can see that according to this peak analysis of gold, we're expecting a peak of the 18-month cycle to form round about now. There's a very staggered nest of highs there, but we're expecting the 18-month peak to form now, which again, in my opinion, is really quite interesting. Many people acknowledge the peak, that gold is forming some kind of a peak now, but when you ask them what is the magnitude of that peak, people will often say, well, I don't really know what the magnitude of the peak is. Let's have a look at some zigzags. We're going to have a problem with the zigzags. Here we go. Because of the fact that very long overdue cycle trough has not been found. There we go. So let's just zoom out. Oh, too much. Okay, here we go. Okay, so here you can see the zigzags. Let's focus on that long cycle. That's the 42-month. I'm using a short nominal model here. That's the 42-month cycle. And so here you can see that projection. The zigzags have a circle around them to give an indication of where that projection might be considered to be complete. And you can see price end of last year came down, dipped into that circle. So in my opinion, I think that that projection is complete. So we are now looking at a move up, at a bounce up. Let me see if I've got a 14-month. Okay, it hasn't yet closed this one off yet, Bob. You can see the projection for the move downwards. It's still projecting a further move downwards, which in my opinion is clearly not the case. But let's zoom in and see on a much shorter time frame, see what it's showing us. And here we go. Okay, so here is the 80-day. So there is the 80-day cycle peak, which it is claiming was formed over there. That's the 80-day cycle peak, and it's expecting price to move down to this kind of area over here, about 1175. Of course, it's come down in the first part of its zigzag. It's now expecting a pull up again, so it'll pull up and possibly form a double top, who knows, come down to the 80-day, and then in fact the 18-month cycle peak might still be ahead of us. So we're going to start having to answer questions like, has the 18-month cycle peak now occurred, or has it not yet occurred? Okay. So I hope that answers that question in terms of what's happening with gold. Gold is dropping out of a peak that is of at least 80-day magnitude, according to this analysis. And it looks as if though it is, according to this analysis, expected to give us a bit more of a pop-up to form the 18-month cycle peak. The 18-month cycle peak is expected in the second week of March, so that's something to look forward to. So I hope that answers that question about gold. And I think I've missed some others here. Is there a significant difference in analysis results if you use trading days versus calendar days? Yes, Brian. No, there isn't a significant difference. Sentient Trader only uses calendar days because it's one of the basic tenets of Hurst's approach to the markets, is that cycles move in time, whether we're trading or not. It's a very important point. No, there is not a significant difference, and in fact I can show you that because I think I have MetaTrader 4 here. Here we go. I've got MetaTrader 4. This is just the euro US dollar. Okay, I'm looking at a different analysis here. This is using the new up and coming Hurst cycles indicator for MetaTrader 4, and it of course forms a peak analysis and a trough analysis, and so it's stating here a 20-week cycle peak, here a 40-day cycle trough, and it's claiming that the peak of last week in the euro US dollar was a 40-day cycle peak. So the MetaTrader 4 indicator does use calendar days, but it works on a trading day chart, of course, because MetaTrader 4 doesn't plot blank periods over weekends. So I guess the correct answer to your question, Brian, is there is a difference in analysis results, yes. Is it a significant difference? No. In my opinion, it's not a significant difference, but there is a difference. Okay, I hope that answers that question. Jay, do you still have March special for subscription? Thank you. Yes, Jay, yes we do. I'd need to check when it's coming to an end. Let me show it to you. On Hurst Signals, we're offering Hurst Signals at half price for your first month. There you go, Jay. You can't click on that link in this video, unfortunately. You can't click on it. You might need to sort of copy it or write it down. Pause the video or something. But there are the links for getting Hurst Signals your first month at half price. I'm pretty sure that that special ends tonight. I'll confirm that, but in fact, perhaps we'll run it until the end of March. I think maybe we'll run it until the end of March. But there you go. Jay, thank you for your interest. If you are interested in subscribing to Hurst Signals, you can get your first month for half price. That means you get 3 instruments for $19.50, and you get 8 instruments for $39.50, I think. Never try and do maths while you're speaking on a webinar. Vivek, can you please analyze the index Nifty whenever you have time, or on a blog, or maybe next webinar, when you're starting Indian instruments? Vivek, did you send a message to support? Because I had Michael ask me to do an analysis for the Nifty. Yes, I'd be very happy to do an analysis of the Indian Nifty, and I'll try and slot it in either in a webinar or on a blog post. When are the new Indian instruments starting for Hurst Signals? We have a range of new instruments, including the Russell 2000 and a whole lot of other forex pairs, US dollar, Japanese yen, a whole lot of new instruments. I'm not sure when the Indian Nifty is scheduled, but they are on their way. Frank, which other platforms other than MetaTrader 4 will the indicators become available? Frank, we are initially developing the plugin for MetaTrader 4. We also have NinjaTrader, eSignal, but we will have it coming out for several trading platforms. Thank you very much for joining me. Brian says eSignal. Yes, indeed, eSignal is going to have a Hurst Cycles plugin, which means you can analyze your Hurst cycles on your eSignal platform. So thank you so much for joining me. I wish you very profitable trading over the weeks to come. Our next webinar is in 2 weeks. I look forward to seeing you there. Thank you for your interest in Hurst Cycles, and thank you for being here.